How and what kind of financing should I get? This is one of the most common questions I get from my students and clients. Now, the answer depends on your financial markers and scope of the project, but in short, you have to align the project or business timeline with the terms of the loan or funds. I'll explain that a little bit more here in a bit. But for 97% of the people out there, I have narrowed down 4 main categories of financing that you can use for your next land hack or real estate deal. Let's get into it. Now, we've got a little bit more than a week before I host my live land hacking webinar, Friday, July 16th, 5:30 p.m. Pacific Standard Time. And in that training, not only will I go over some of the core principles of land hacking, but I'll also field questions so you can come and ask your biggest burning ones. Be sure to head over to my website, kaiandrew.com, and snag yourself a seat. And because it is a live event, there is a seat capacity. So if you can make it, be sure to reserve your seat sooner rather than later. Now, while you're on my site, everything I'm talking about in this video, I'm putting it in a nice, neat, little compact PDF guide to help walk you through your financing options and what I would recommend you do before you even seek out funding. Now, before we get into the actual forms and ways of financing, I wouldn't be a good educator if I didn't preface it with the fact that you should be aware of your financial markers and standings. It's not that difficult once you get things set up, and really only takes maybe a couple hours a year to manage and track. Literally like 2 to 3 hours a year. It's not difficult, time consuming at all, and has given me a perfect or near perfect credit score because I just did have a hard pull. Now, the basic financial markers I'm talking about boils down to 4 things. Steady income, have at least one. Credit score, 720 plus is ideal. Debt, 0, obviously. And then cash as high as possible. But before getting into this world of real estate, I recommend a bare minimum of $30,000. And then 5th is backup liquidity. This could be stocks, crypto, mutual funds, and another $30,000 here would be ideal too. Now, I know I did say 4, and I actually meant 5 because I can't count. Now, I'm not a traditionalist at all. You probably know that if you've spent any time watching my videos or on my channel. I dislike the fact that I even have to address these markers just to please certain institutions. But when I play basketball, which I suck at, I don't complain that the 3-point line is too far away from the hoop and I'm too short. I understand the rules and I play the game to my advantage. Same thing here when it comes to real estate and finances. If you want to step into the game of real estate and you're not already independently wealthy or have a rich family, we have certain rules that we have to play by. You and me both. The nice thing is once you have these factors set up, you'll realize you build some really nice habits and financial skills that will only help you later on in the project. Cash money. The first category can't be much more straightforward. In the thousands of years of humans using all sorts of forms of currencies, cash is still king. Obviously, the first option is your own cash or perhaps families or a business partner if you're not doing this alone. But this is actual cash that you have, not a cash advance or anything tied to some sort of debt service or payback period. Another version of cash that's a bit more advanced, actually way more advanced, and I don't recommend to anyone beginning, is investor cash. Basically, it's not a loan, but it's an exchange for equity inside your business. Think of like silent business partners. Things can get legally and financially complicated here, and I wouldn't even recommend this until you've gotten a couple of good, successful land hacks and real estate deals under your belt. However, once you open up this bag, you'll have access to almost an endless amount of funds through syndications, high net worth individuals, and perhaps even institutional money, assuming that you're profitable and you're able to hit certain benchmarks. This is good for you to know, but not the right tool for us now. Conventional loans is perhaps my favorite category other than having a generous rich friend or uncle, especially right now. Now, my thumbnail was not clickbait because at the time of this video, you can still access what is deemed free money. The reason is because we're about to enter a time of inflation, great inflation. Who knew that printing $6 trillion in 12 months would cause crazy inflation? But historically, inflation in the US hovers around 3% year over year. That means if you have $100,000 sitting in a checking account right now, you will lose about $3,000 in buying power each year. That's why we invest, to curb inflation and make some gains while we're at it. Now, if you are to go out today and get a standard 30-year fixed mortgage, you will see that rates are hovering right around that 3% range. Almost half that if you get a 15-year fixed. Meaning that if you pulled out a loan, you'd be paying the same amount as the historical average inflation rate. So if you'd be paying 3% either way, why not own some equity and an income producing asset? You're using someone else's money to generate you wealth. And you also get several tax advantages such as depreciation and tax write-offs. That's not too bad either. Better than sitting on cash. Hands down, US mortgages are one of the best financing tools for beginners if you know how to leverage it and you find the right piece of land. Okay, with that explained, in this category, we have three main loans for us to choose from: traditional 15, 30-year fixed mortgages, construction loans, and land loans. Now, I won't get too deep into them because there's tons of videos out there on YouTube, but we should all know what a traditional mortgage is. You basically find an appraisable piece of property with a dwelling structure, and the bank gives you a loan amortized over 15 to 30 years, and you pay a fixed rate. Construction loans are a bit different, where you have to come with a signed contract with a reputable builder or general contractor before they release funds, or even consider releasing funds. Sometimes they'll ask for multiple quotes from different builders before they approve of one. Construction loans are treated as a line of credit and released in phases. This means that interest rates are variable. Once construction is completed and the home receives its certificate of occupancy, the loan will then be converted into a fixed rate mortgage. Land loans are a little bit more rare and can be all over the board. There are three types of land in the eyes of the bank: improved, unimproved, and raw. Put simply, improved has all utilities and ready to go, unimproved has some, and raw is completely untouched land. Obviously, each has a very different risk factor to the bank. At the end of the day, it comes down to how strong your financial markers are, your relationship with the bank, and if they even offer a land loan product. The problem with these is that they typically require 40 to 50% down, which is a ton of cash up front. Short-term financing options is all relative. I'm defining short-term as anything under 5 years or meant as a quick funding solution. The three here are personal loans, HELOC, and hard money. Personal loans are pretty simple and straightforward, just a standard loan from a lender that checks your financial markers. However, the loan amount is relatively small because it is not normally attached to a large asset such as a house. Good thing is that interest rates can be competitive, but terms are very short, usually around 3 to 5 years. HELOCs stand for Home Equity Line of Credit, and these are probably one of my favorites. I usually always have one or two of these available on my properties, and it's basically a giant credit card that's attached to the property's equity. The more equity you have, the higher your credit balance is. HELOCs are a sweet mix between a credit card and a fixed rate mortgage. For example, I have a HELOC that is amortized over 20 years, 3% interest rate, and interest-only payments for the first 10 years. These are great to use for build outs and even purchasing new properties for a quick all-cash deal, and then you have to find a way to pay it back. Hard money is another short-term financing tool where you work with specific hard money lenders. These are usually private money lenders or individuals who are not regulated by the Federal Reserve, so terms can be all over the board. There's really no standard here. But typically speaking, higher fees, interest rates are 2 to 3 times higher, sometimes greater than traditional mortgage, and the payback period is between 6 to 12 months. Talk about short term. These are specifically used for very short-term needs where you know you can get the money back and pay off your hard money lender. Key thing to note is that if you can't pay back the loan in time, the interest rate usually ratchets up very quickly, and if you miss a payment, there are heavy consequences, including losing your property. These guys do not play around, so be sure you understand what's happening before you jump into hard money. The last category is what I call others, and it's the fringe options that are not too common, but still viable for some of us out there. There are many others that I don't include in this, such as co-op loans, but if you have any others that you know of or would like to share, please put it down in the comments section. I'm sure somebody would love to hear about it. The three I like to highlight are USDA loans, SBA loans, and then seller finance. USDA loans, or the Department of Agriculture, actually has a loan service department for people interested in purchasing agricultural land. Their terms will not be as ideal as a conventional bank loan, but it does give us options when it comes to buying rural or properties way outside in the country. Obviously, there are some strict requirements here to become qualified with the USDA, but definitely an option if you're looking at buying agricultural land, which is one of my favorite zoning districts for land hacking. SBA loans or small business loans are a decent option too, but will require you to go through the SBA process, which requires strong personal and business credit, proven business model, and consistent cash flows. It's very difficult to get an SBA loan if you're a new business or you don't have the correct business documentation. I'd recommend this path only only once you get a few profitable sites up and going and you have a strong history. The last is seller finance, and to be honest, one of my favorites. You cut out the middleman of lenders, government, and banks. This comes down to how you negotiate the deal, and there are no standards here. As long as you make it a win-win situation, seller finance deals can be a home run of a deal. But just like the bank, if you mess up, the owner can take back the entire property with no recourse. Now that was a lot, but remember, you can download the PDF guide and see the snazzy little chart I made over here on kaiandrew.com. While you're there, don't forget to reserve your seat to my live training webinar where I go over the core concepts of land hacking and answer your questions. I love interacting and helping you, especially when it's all live. So be sure to jump over there to my site, grab your seat before they're filled up. And unfortunately, there is a limit to hosting live events and webinars. You know the drill by now. Like and sub. And if you want to stay posted on my projects, jump over to my Instagram right here. Love you all. See you in the next video. Kai out.